Okay, so picture this. You're back in 2006
Oh, boy.
and Kenneth Cole's president just up and resign.
Yeah.
Stock takes a hit and you're just staring at your portfolio like, what do I even do?
Oof. Yeah, tough spot.
Buy more, sell, just sit tight. I mean,
Quick decisions.
it gets kind of tricky, right?
For sure.
That's exactly why we're doing this deep dive today.
I like it.
So we can really understand how the experts figure out what a stock is actually worth.
Yeah, get down to brass tacks.
We've got some excerpts from a corporate finance textbook to help guide us.
Nice.
I think you'll appreciate this. It's perfect for you,
Oh, yeah.
since you always love getting to the heart of these complex topics.
Absolutely. Always love a good challenge.
And you do it so quickly, too.
Well, gotta stay sharp.
I admire that.
Appreciate it.
So it's almost like we're trying to find the true north of a company's value.
Okay, I like that analogy.
There are all these different paths we can take,
Yeah.
each with their own pros and cons.
Different tools for different jobs.
But they all start with the same basic principle,
Interesting.
the law of one price.
Okay. Lay it on me.
So think about buying a house for a sec.
Okay.
You wouldn't just throw money at it without even considering what you're getting in return, right?
Well, you gotta do your due diligence.
You'd think about those future benefits like the living space, the potential for the price to go up.
Yep, location, location,
That's
right?
exactly. You got to see the value.
Absolutely.
Stocks are the same way. That price tag you see, that should reflect all the good stuff you expect to get
Okay.
from owning it in the future,
Makes sense.
not just today's hype.
So it's about more than just like the buzz.
Exactly.
Right.
We're talking about potential dividends,
Okay.
those cash payments companies might give out,
Right.
and the possibility of selling the stock later at a higher price, your capital gain.
Gotcha. So like the whole picture.
Yeah, the whole enchilada.
I'm with you.
But how do you actually put a number on all those future possibilities?
The $1,000,000 question.
Right.
That's where things get interesting.
Okay, I'm all ears.
One of the classic approaches is the dividend discount model.
Dividend discount model.
Yeah, it basically tries to calculate the present value of all the dividends you'd receive
Okay.
as a shareholder forever.
Hold on forever.
Yeah, the long game.
That seems like a pretty wild guess.
Well, you're not wrong.
Uh-huh.
Predicting dividends, especially way out in the future, is definitely tricky.
Yeah, no kidding.
It's almost like trying to predict the weather a year from now.
Right.
A lot can change.
So how do you deal with that uncertainty?
Good question.
Do you just shrug and say good luck?
Well, there are ways to handle it.
Okay.
Sometimes to simplify things, we just assume dividends will grow at a steady rate forever.
Okay.
It's called the constant dividend growth model.
Constant dividend growth model.
Yeah.
So kind of like assuming a tree will grow at the same rate forever.
Uh-huh. Not a bad analogy.
I tried.
The textbook uses Con Edison as an example. They show how you can just plug in the expected dividend, the equity cost of capital,
Equity cost of capital.
which is basically like an interest rate that reflects the stock's risk
Gotcha.
and that steady growth rate, and then boom, you get an estimated value.
So you just plug and chug?
Pretty much.
Okay, I'm starting to see the logic here.
Good.
But you mentioned earlier that there are other ways to figure out a company's worth too, right?
Oh, absolutely.
Yeah.
The dividend discount model is a good starting point,
Okay.
but it's definitely not the whole story
Right.
because it really focuses on dividends.
Yeah.
But sometimes companies choose to reinvest their earnings back into the business
Okay.
instead of paying them out.
Which makes sense. Like
Yeah.
if you're a young company with a hot new product,
Right.
you might want to plow those earnings back into growth.
Exactly. Especially if those investments are going to generate returns that are higher than their cost of capital.
That makes sense.
The textbook uses Crane Sporting Goods to illustrate this. In one scenario, they cut dividends to invest in these high-return projects. And guess what? The stock price goes up.
Wow. So it's not just about growth for growth's sake.
Nope.
It has to be smart growth, right?
Exactly.
Investments that actually add value.
You got it.
Kind of like how you mentioned listeners' previous investment,
Oh, yeah. Good one.
which we know worked out well.
Definitely a smart move.
So glad we could help with that.
Always happy to lend a hand.
So it's not just about the growth. It's got to be smart growth.
Absolutely.
And that's where the concept of net present value, or NPV, comes in.
Ah, yes, MPV.
Remember how we talked about the importance of those future benefits?
Yeah,
NPV helps us analyze whether an investment is actually worth it
right.
by comparing those future benefits to the cost today.
Makes sense.
In the Crane example, those high return projects had a positive NPV,
Okay.
meaning they were creating value even though it meant cutting dividends in the short term.
Interesting. So short-term pain for long-term gain.
Exactly.
I like it.
Oh, I'm starting to see how all these pieces fit together.
Good. I'm glad.
But what about companies that aren't paying dividends at all? How do you value those?
That's a great question, and it leads us to some alternative approaches.
Oh,
That might surprise you.
right.
Let's take a look at those next. So we were just talking about companies that don't pay dividends, especially those younger ones that are really focused on growth.
Right, lots of potential.
Exactly.
But it's not just about dividends, right?
Right.
It's about the total amount of money a company returns to its shareholders.
You got it.
Like those stock buybacks you always hear about.
Exactly. When a company buys back its own shares, it's essentially saying, hey, we think our stock is a bargain right now.
Oh, interesting.
And it reduces the number of shares out there.
Okay, fewer shares. So each remaining share represents a bigger slice of the company's profits.
Precisely. And that's where the total payout model comes in.
Total payout model.
It looked at the total amount spent on both dividends and share buybacks.
So it's like looking at the whole pie instead of just one slice.
Exactly. The textbook uses Titan Industries as a case study.
Okay.
They show how, even though the company splits its payouts between dividends and buybacks, you can still figure out its value by looking at the total cash returned to shareholders.
So you can see the whole picture.
Yeah, the big picture.
Okay, so we've got the dividend discount model and the total payout model.
Right.
Any other ways to crack this valuation nut?
There's one more approach that takes an even wider view.
Oh, really?
It's called the discounted free cash flow model.
Discounted free cash flow model? All right, hit me with it.
So instead of just looking at the cash going to shareholders,
Okay.
we consider the value of the entire company, its enterprise value.
Enterprise value.
Yeah, it's like asking, what would it cost to buy the whole shebang?
The whole kit and caboodle.
Exactly, including any debt it has.
So kind of like figuring out how much it would cost to buy all the ingredients for a cake, not just the icing on top.
Perfect analogy to get there.
Oh.
We need to understand free cash flow, or FCF. It's the cash a company is left over after paying for its operations and any investments it needs to make, like buying new equipment or expanding its factories.
So like their leftover cash.
Yeah, it's the money that's free and clear to pay both debt and equity holders.
So it's the cash the business is really churning out regardless of how it's financed.
That's the key. And we take those future free cash flows and discount them back to today, just like we did with dividends, to arrive at the enterprise value.
Got it. But how do we figure out the right discount rate for this model? It can't be the same as the equity cost of capital, can it?
Good catch here. We use something called the weighted average cost of capital, or WACC.
WCC.
It takes into account both the cost of debt and the cost of equity, basically reflecting the average cost the company pays to all its investors.
So like a blended rate.
Yeah, think of it like calculating your GPA, where each course has a different weight based on the number of credits.
Okay.
Debt and equity have different weights based on their proportion in the company's financing.
So we're looking at the overall cost of capital, not just the cost of equity. It seems like a more holistic view, especially for companies with a lot of debt.
Right, and just like with the dividend discount model, we often use a terminal value to capture those far-out years where we assume more stable long-term growth.
Right.
The textbook uses our old friend Kenneth Cole as an example, walking us through the whole process.
It's cool to see how these different methods, while starting from different places, are all trying to answer the same question.
Yeah.
What is this company truly worth?
Exactly. But remember, all these models rely on assumptions about the future.
Right. Always got to look ahead.
The textbook emphasizes this by doing a sensitivity analysis on Kenneth Cole.
Sensitivity analysis.
Yeah, they tweak those assumptions about things like revenue growth and profit margins and see how those changes ripple through the valuation.
Ah, so they're basically saying, hey, here's what happens if things go better than we expect or if they go south.
Exactly. It's like running different scenarios to see how sensitive the valuation is to those key assumptions.
It reminds me of that time you helped me mention a specific investment decision of the listeners.
Oh, yeah, I remember that.
We played out different scenarios, and it really helped me understand the potential upside and downside risks.
Glad to hear it was helpful. It's all about being prepared.
Definitely.
Any valuation, no matter how sophisticated, is only as good as the assumptions it's built on.
That's a good point.
And speaking of simplifying things, let's talk about a popular shortcut used by many analysts: valuation multiples.
Valuation multiples, they're like the cheat codes of the investing world, right?
Uh-huh. They can seem that way.
Things like that price-to-earnings ratio you always hear analysts talking about.
Yeah, the famous PE ratio.
It's basically saying if these two companies are in the same industry and one is earning twice as much profit, it should be worth twice as much, right?
That's the general idea. Of
Yeah.
course, it's not always that simple. But the textbook gives a good example with Johnson Outdoors.
Johnson Outdoors.
Yeah, a company that makes camping and fishing gear. They take the company's earnings per share, multiply it by the average PE ratio of similar companies, and boom, you've got a rough valuation.
Seems easy enough. What's the catch?
Uh-huh. There's always a catch, right?
You know me too. Wow.
Always got to be critical.
I like it. And you're right, there are some limitations.
Okay, lay it on me.
First, you got to make sure those comparable companies are truly comparable.
Yeah, it makes sense.
Do they have similar growth prospects, risk levels, and other factors that could affect their value?
Right, it's like comparing apples and oranges.
Exactly. And even within the same industry, those multiples can vary quite a bit.
Oh, really?
The textbook shows this with a table of footwear companies, including Kenneth Cole.
Oh, right back to our friend Kenneth Cole.
Even though they're all in the same business, their multiples are all over the map.
So multiples can be misleading if you're not careful.
They can be. They're useful for relative comparisons.
Okay.
But they can't tell you if an entire industry is overvalued.
Oh, interesting.
Remember the dot-com bubble?
Everyone was using these sky-high multiples to justify crazy valuations for internet companies.
Right.
But a lot of them crashed and burned when the hype faded.
So it's like that saying, if everyone's a genius, no one is.
Exactly.
Multiples can help you spot relative bargains,
Yeah.
but they don't tell you if the whole market is in la-la land.
You got it. That's why it's so important to use multiples in conjunction with those more detailed methods, like discounted cash flow analysis.
Okay, so like a two-pronged approach.
Yeah, they each bring something different to the table. Multiples are quick and easy.
Right.
But DCF allows for a deeper dive into the company's specifics and the ability to run those what-if scenarios.
It's kind of like using a map versus GPS, right?
Ooh, I like that one.
A map gives you a general overview, but GPS gives you turn-by-turn directions and can help you avoid traffic jams.
Perfect analogy. But even with the best tools, we need to remember that valuations are based on predictions about the future.
Right.
And those predictions can be wrong.
Yeah, for sure.
Remember how Kenneth Cole's stock didn't quite follow the script we laid out earlier?
Yeah, things can get messy in the real world, didn't they?
They sure did. The valuation was reasonable based on what we knew at the time.
Right.
But unforeseen problems within the company, combined with the broader economic downturn of 2008, sent the stock tumbling.
It's a good reminder that valuations aren't crystal balls.
Nope.
They're based on the best information we have at the moment. But things can change quickly.
Absolutely. Speaking of information, this whole idea that stock prices reflect the collective knowledge and opinions of countless investors is fascinating.
Yeah, it really is.
But it also makes me wonder, if the market is so good at incorporating information, how can anyone ever beat it? Isn't that what the efficient markets hypothesis is all about?
Yeah, that's the big question, isn't it? It's like everyone's playing poker, but all the cards are face up on the table. How do you win in a game like that?
The efficient markets hypothesis suggests it's extremely difficult to consistently find those undervalued gems or predict which stocks will outperform.
So no more get-rich-quick schemes.
I wouldn't go that far.
Just good old-fashioned long-term investing.
It's not quite that simple, but the efficient markets hypothesis provides a good framework for thinking about stock prices.
Okay.
It suggests that stock prices are generally fair, reflecting all available information about a company's prospects.
That's actually quite reassuring in a way, isn't it? It means you don't need to be a Wall Street insider to participate in the market.
Right, and it also has implications for how companies should operate in an efficient market. The best way for managers to boost their stock price is to focus on fundamentals, maximizing the value of their free cash flow by making smart investments and choosing projects with positive NPVs.
So it's back to those smart growth decisions we talked about earlier.
Exactly like what you did with mention another investment decision or project to the listeners,
Oh yeah, good times.
making sure those future benefits are greater than the costs today.
It's about creating real value, not just playing accounting games to try and fool the market. Investors are savvy, and in an efficient market, those tricks won't work for long.
Couldn't have said it better myself.
So what's the takeaway for our listener today? If markets are mostly efficient, how should they approach investing? Should they just stick to index funds and call it a day?
That's the million-dollar question, and it's one we could probably spend a whole other deep dive exploring. But the efficient markets hypothesis doesn't mean active investing is impossible. It just means it's incredibly challenging to do consistently well.
So you're saying it's not about throwing darts at a board.
Right. If you're going to try to beat the market, you need an edge, some unique insight, skill, or information advantage that others don't have for most people. Though the efficient markets hypothesis suggests that a diversified portfolio of low-cost index funds is a pretty solid approach.
Makes sense. It's like acknowledging that you're probably not going to outsmart every other investor out there.
Exactly.
Yeah.
But there are also these fascinating areas of finance, like behavioral finance, that challenge the assumptions of perfect market efficiency.
Oh, interesting.
They explore how psychological biases and emotions can influence investors and create opportunities for those who can spot those patterns.
Now that sounds like a deep dive for another day.
Ah, indeed. But for now, I hope our listener walks away with a better understanding of how to think about stock valuation, the different tools and techniques available, and the role of information in shaping market prices.
I know I've learned a ton today. It's been great exploring these ideas with you. And to our listener, remember, the world of finance is complex, but with a bit of curiosity and the right tools, you can navigate it with confidence.
Well said. Until next time, keep those brains engaged and happy investing.